Hello, John Pattullo, co-manager of the Henderson Strategic Income team. I want to give you a brief update of what we're thinking in 2017. Our current marketing stall is really set up as follows. Reflation for now, but will it last? I think the economies were experiencing a cyclical uptick pre-Trump, really from July of last year, where US Treasury yields got to roughly 1.31%. Now, this uptick, really with some work that Simon Ward, our chief economist, has done, we suggest was really driven by some monetary loosening in financial conditions in China about a year earlier. So you had a coincident uptick in economic activity in PMI data and so on in the States and in the UK and Europe. And this is not to be confused with the Trump rally, because the rotation seen in equities from defensive to cyclicals towards banks, to being long dollar, towards financials and so on, was already happening. And if anything, the Trump bump, if you like, may actually exaggerate this. And that's really our core belief. That may well coincide with Trump's inauguration, which of course happens this Friday. And I think this cyclical uptick should not be confused with the long-term structural trends that we've written and the team has written about all year. Now, Simon's done some further work to suggest that money supply is already shrinking a little bit in China and a little bit in the States. And we suggest there may be a mild slowdown in activity around the springtime. Now, we feel the Fed is desperate to raise rates. And history would suggest that whenever the Fed talks tough, they haven't had the economic data to justify rate rises. Of course, they've said they want to raise rates 3 times this year, having suggested they wanted to raise rates 4 times last year. There is a chance they may go in March if the data is strong enough, because they're desperate to raise rates. But we think they may actually confuse the cyclical uptick with the long-term structural issues which we've spoken about for a long time. Positioning in the bond markets is really interesting as well, because into year end, and most recently, the short interest, the amount of speculators who are actually short US Treasuries, is at record levels. And these shorts keep getting shorter. The economic data remains strong, and rather amusingly, bond yields have actually fallen, as in prices have risen really all year, from roughly 2.6% in the US Treasury years to today's 2.30 or so. So the data is strong, but everyone is already pre-positioned for this, which obviously brings a bit of a short squeeze rally into what is a massive week for markets. So it's an unusual picture we have. We think a lot of the hard work of, if you like, some of the destruction in value was really happened in Q4 of last year, where bond yields were pretty tough. Now, many a commentator is saying that the 30-year bond bull market is over. Certainly some of the damage, or rather there has been some damage done to the long-term technical picture, but until the 10-year really breaks above the sort of 3% level, we're not convinced that you need to call the end of the bond market. And if anything, they may wash around a little bit, roughly in a kind of 2 to 3% range, maybe for many years. We're not convinced the downtrend is going to continue, but a long-term basing pattern may be happening. And it's interesting that Treasury yields last July got to 1.35%, and that was the same base that they hit actually 4 years earlier in July of 2012. But generally, we try and have an open mind with duration, so post-Brexit, we actually went long duration, and post-Trump, we actually went quite aggressively short, given the different responses in monetary and fiscal policy, which were respected, and the effects that those policies had on their respective currencies. We are mindful that positioning is quite extreme as well, but it did strike us that all the investment bank outlooks this year was very consensual. So everyone hated bonds, everyone loved equities, everyone loved the dollar, everyone loved reflation. We just think there's a bit of reflation going on now. It may be getting a little bit long in the tooth. There's some evidence it may be turning a little bit within equity markets, and maybe looking at the gold price and the Japanese yen and so on. So we're respectful of it. But longer term, we still have massive sympathy with a lot of the secular trends that we've spoken about for years now. Richard Kuh's balance sheet recession, Larry Cummers' secular stagnation, the lack of productivity in the world, the debt trap, the demographics, the digitalization, and so on. And I think a lot of those issues may well become a lot more pertinent in the second half of the year, or even earlier. So with that in mind, what are we doing? Well, generally in this environment, we like loans a lot. We like high yield bonds a lot, especially the large cap non-cyclical single Bs and some of the double Bs. And we've really got a watching brief on financials. We favour shorted dated American and some European banks and insurers, but generally have a watching brief on duration with a view to potentially extending or potentially shorting, subject to how the world's economies look going forwards. As ever, we're very focused on sensible income, large cap, sensible, reliable businesses which will pay the coupon. And I think this year the coupon should look after investors reasonably well. Thank you very much for listening.